Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. It's that time of week again where my business partner, Sam Russ, takes over the show and interviews our guests. I hope you enjoy the show.
This is your daily real estate syndication show. I'm your host, Sam Russ. Today, we are joined by Jay Tenenbaum. Jay is with the Scottsdale Real Estate Investments and has acquired over 450 distressed mortgage notes and real property in more than 30 states in his real estate career. Jay has a background in the legal field as well. We're excited to have him on the show. Thanks for joining us, Jay.
Thank you, Sam. Well, pleasure to be here.
Excellent. Jay, I wondered if maybe we could start with how you got into mortgage notes. As we were chatting before the show, you mentioned you had been in the legal field working in debt collection for a number of years, and then you've transitioned into mortgage notes. What was that journey like? How are you where you are today?
Sure. So first of all, I like to say I've been in debt all my life, just not personally, right? So I was a debt collection attorney for 20 years, 2009 to 2012, started investing in buying judgment liens in California and executing on real property. And then late 2013, got exposed to, mortgage note investing, and it was an easy transition, just another debt instrument, different debt instrument, and made that transition very, very, swiftly.
Oh, that's excellent. You guys focus on secondary markets. I'm curious why you guys have picked those markets, what you would call a secondary market, and why that works for you and your team.
Sure. So secondary markets are, first of all, twofold to this. One is we are buying distressed mortgage notes. Okay, so for example, Bank of America, Morgan, JP Morgan Chase, whatever, originates a loan to you back whenever, right? And then you sell it. They sell it on the market 5 minutes later, and they sell it to some hedge fund who strokes a 7-8 figure check, who then sells it to another hedge fund for $1.95 more, and ultimately trickles down to smaller investors such as ourselves, where up till now the loan has just been in default, and nobody's talked to a borrower, nobody's started foreclosure, nobody's done anything. And so when we pick it up, we go, like I used to say, like Star Trek, we'll do where no one's gone before. We'll actually work the note through, whether we're speaking to the borrower or starting foreclosure.
And so you guys specialize in non-performing notes, is that correct?
Correct.
Yeah.
Because for starters, it's easier. Well, because of my background, I can, in the very beginning, cut my teeth buying, what we call low balance assets, meaning the houses in those areas were worth $50,000, give or take, right? You're buying these loans for like, $5,000, $10,000, and you're having a conversation with a borrower, and all of a sudden, you're getting a $300 a month, loan modification payment. Your return on investment is awesome, right? And so if you think about it, if I'm buying a note for 10 grand and I'm getting a $300 payment, I'm getting a 36% return annually, right? I've turned that non-performing loan into a value-add performing loan, right? Now, the performing market, I'm probably paying $25,000, $30,000 for that or more. So my return is not as great. I'm paying the premium for the instant cash flow. Because of my background, it's easy for me to do. Going back to what you said before with regard to secondary markets, I also established my forte where when I started investing. I lived in California. I moved here in Arizona about 4 years ago. I've never bought anything, wherever I lived, whether it was California or Arizona. So I always learned how to buy stuff out of state, because in the Midwest and South primarily, that's where the better opportunities exist. You're in judicial foreclosure states, so this process takes longer, but ultimately you get your better discount because of that. California's Arizona are, deed of trust states. Mortgage, foreclosures take 5 minutes. And for that, you'd be paying a premium for them.
Yeah. And so what are the risks, and what's the typical investor profile? You guys work with people from around the country. There's pros and cons. I mean, you kind of outline there's better yield in the non-performing notes. Are you guys taking strictly first position notes? And if so, how do you ameliorate the risk? If you're taking second position, it can take a little longer to unwind. Say you can't get a note performing, you have to go through that foreclosure process. How long does it take to actually realize a gain?
Sure. So first of all, a couple things. Number one, I've only invested in first. There's various reasons why not seconds. One is it's better being first than second. But seconds, just the marketplace was atrocious when I first started. The sellers in the industry weren't that reputable. Plus, there's just much more risk involved in seconds. You got them at steeper discounts, but there's just much risk involved. With regards to, so we're buying first. The foreclosure process is in the judicial states, takes anywhere from, could be 6 months to a year. But the thing is, the key is you want to minimize your risk, meaning we started out buying pools of assets. Like I'll buy 3, 4, 5, 10. I think the largest pool I ever bought was like 40 assets at one point in time. So you minimize your risk that way because of the diversification you achieve. Number one. So that's one of the reasons that, like I said, I'm buying first. Diversifying. I've bought pools before where I made one phone call and started generating cash. I've done it several times. A couple of different pools that come to mind where I got a majority of the portfolio cash flowing, very quickly. We bought 21 seller finance notes in September of 2018 for $85,000 total. Right? It was a hedge fund that I bought about 120 assets from earlier. They were getting down to the last of their lot, and almost immediately reached out to. Got about 14 of those performing immediately, spending off about $5,000 a month, almost immediately, right out the door. So yeah, you can generate the cash flow. Now, I also am an advocate. You got to set your backstop. What I mean by that is when the borrower can't get out of their own way, you have to start the foreclosure. I started aggressively only as a backstop because if I'm talking to you and you're giving me lip service and everything else, nothing. The loan just continues to stay in default, and I'm just my ROI goes down. Right. So as I said, the backstop, now my action creates your reaction.
I know in the multifamily world, which is where we play a little bit more, if we as the landlord don't hold up our end of the lease in holding the tenant to the terms of the lease. So it's beyond just, hey, we didn't provide a clean place of habitation. But if we don't initiate eviction proceedings within a certain window, unless there's extenuating circumstances like the moratorium, then we're in default of the lease or we're breaking the lease and we can't enforce its provisions on the tenant. Is it kind of that same methodology for foreclosures?
Well, other than the moratoriums, it's really the investor or the lender's call, right? When you're buying notes, you step in the shoes of the lender. You are the lender per se. It's your call. Those who sit around and don't do it, I think are just doing themselves a disservice, because if the loan's not performing and you're not foreclosing, what are you doing? The loan doesn't automatically start generating cash flow on the shelf, right? It just has got to do something. So, I mean, people, and I know I've talked to certain investors like, well, I don't want to spend the money to do it. I bought a loan for $2,000. Okay, but it's not doing anything. So it's only $2,000. Your risk is minimized because your investment's not huge, but it's not doing anything. So you put a little bit of money into it, you start foreclosure, you get the money back because most states, the foreclosure fees are recoverable. And now you generate some reaction by a borrower, and who knows? It's like when a tenant just runs and jumps up. When a tenant runs and jumps up and pays the past due rent, right? You have those kind of tenants. You got to almost threaten eviction or send them an eviction before they run up and pay. Well, that's the same thing happens here.
Yeah. That makes a lot of sense. Coming into managing all these properties, I mean, you're in Phoenix, you're acquiring these properties around the country, primarily in the Midwest and in the South. What are some systems that you've put in place? What are some tricks that maybe our audience could use? There's a lot of folks that are investing out of state. It might not be in notes specifically, but what has been key to your success in managing these assets?
The key to the success is building a strong team in those markets. You can build, I've kissed a few frogs along the way, finding the right team members, right? I found on balance, trying to find the national vendors, national property preservation guys, national this, national that, just don't really work out because all they're doing is farming out to a local affiliate anyway. You might as well go direct and engage a local affiliate in that market. Your team building usually starts with finding that good realtor who likes working with investors, who has the connections or their own contracting crew already. Secondarily, if you're even if you're not even buying rentals, a property manager knows everybody anyway, and that pretty much affords you. There's where your team starts. Now, with Scottsdale, we've grown and we've added team members to kind of oversee that. Like, for example, we have our own project manager now in-house to deal with building local teams himself, right? It just takes the burden off of us. Although we've got some very strong teams in some very strong areas. New Orleans, Pittsburgh, we've got extremely sound team members.
How do you find a good team member that you're going to actually hire? So there's the step of building a collaborative team, property management, all those pieces that you alluded to, certainly crucial. But when you scale to the point of actually bringing on board your own employees, finding that right person can really be a 10x multiple in your business, or it can be a huge drag. How have you guys gone about finding that right person for those shoes?
Good question. So a couple things. Number one, when I managed my law practice, I had 45 hangnail employees, and managing employees almost did me in. Actually, pretty much did me in. I swore I never wanted another employee the rest of my life. As we've grown our business and learned and decided we had to scale, we've been actually fortunate. My business partner and I are actively leaders in a local, what started out as a local real estate community here in Phoenix, which is now with Zoom gone, global, right? And so we've brought in team members who are other members of our community already. So we already know them. We've already, seen what they can do and what have you. And that's the pool that we're swimming in to grow our team.
I noticed on LinkedIn, Jay, that you're a member of, or a co-chair of the Ambassadors Community in Alliances, spelled ELIANCES. Is that part of the environment that you're talking about, of putting yourself in those right circles to observe people, work with people, and then pick those high performers?
No, but it's comical, but there is a connection. So when I moved here to Phoenix 4 years ago, I was seeking community, and I saw, and I'm sure you've seen them, the bandit signs out there, hey, real estate mentor seeks trainee, earn while you learn, all this other stuff. Well, that is really, and I knew what it was from California because I knew what it was, and buddies of mine were doing it, but they weren't very strong there. But when I came out here, I knew exactly what it was, and I knew that in seeking community, that if I got into, had a conversation with the leaders of that community and said, look, real estate communities, real estate programs live and die by the ability of the members and the students be able to do deals. If you can't find a deal, you disengage and you move, you leave, right? And so I came into this community going, hey, I can bring deal flow. I've got connections with banks and hedge funds with regards to my note experience. I can bring deal flow in the community if that's something that you guys are interested in. As it turned out, it's grown exponentially from where it started back in 2017. But the leader of that group, at the time that I got involved, the real estate community was called Synergy, and then there was a falling out among their leadership, and it became Alliance Phoenix with an A. But the leader of that community was also a member of Alliances, it's an entrepreneurial community. So he invited me there, and so now I'm a member of both. And we always have the joke of, Zach, why did you rename your real estate community Alliances? Because now there's a lot of crossover people who are both belong to both communities. Like, are you talking about alliances with an A or alliances with an E? And it gets confusing, right? But that has opened up my world. So basically, my world in a nutshell, pre-pandemic was, either doing things inside the real estate community or doing things inside the entrepreneur group, right? Made substantial connections, substantial friendships. It goes on and on. In fact, our software REI Blade is a product of our developer partner, is a person that I met inside our entrepreneur group.
Oh, that's really cool. Thanks for going into a little bit of a backstory there. REI Blade, real estate software. Now you've got me curious, Jay. Could you go into a little bit of depth what you've done there and how you guys utilize that tool?
Certainly. So, in the pandemic, we all learned we had to pivot, right? So we had a little bit of downtime. So it was something that we didn't really pivot in the pandemic. It was something that was created. The birth of it was started with my business partner and our tech partner. They had been talking about it for months prior. But I like to say, there's the old woman who lived in the shoe. She had so many children, she didn't know what to do. Well, we got on such a buying frenzy from the time that we started. My partner and I started working together in September of 18, that we had so many assets under our management, whatever, the spreadsheets and Google Drives and Outlook and all this. I mean, it just was chaotic. And I got to tell you, while it was his brainchild, it was something that doesn't exist, at least from an investor of our caliber, of our size, has never existed in our space. Now, let me take a step back. So in my law practice, we had a terrific software that managed our 6,000 open files. Our paralegals could run files concurrently with our collectors, our accounting staff, and all that, right? And when I got in the note space, I said, okay, what kind of program is available in the note space for this? There wasn't one. There still never was one, right? Now there is one. Well, we started, the brainchild was more a product of when you're working with investors, right, writing your quarterly reports and all that, you wanted a better system, right? That's where it started, right? We basically designing a portal where they could look in and see their own assets. What have we created? Well, it'll create your analytics on a dime. It'll create document management. It'll create help you raise capital through creating your performance, not only, and create prospectuses. It's got a variety of other features that is for anybody, not just note space, single family, multifamily funds. It's for anybody. There's nothing else in our scale. We tried the Appfolios and other things like that. Just they're too big, too expensive, or just not fitting what we wanted. We're not the huge giant. We're not a servicer. We're not a hedge fund. We're not a multi-million-dollar fund. Those kind of programs are out there for them, not for us.
Yeah, having a targeted program like that serves your niche really well. And when you're creating it, you can give it all the widgets you need, but it's not bloated, trying to serve everybody like an Appfolio. We've explored some of those platforms, and we have a similar tool on the multifamily side that's designed just for syndicators of large multifamily projects. Our needs are different than your needs on the note side, but having a tool like that is just paramount to success, particularly as you start to scale and start to deal with a decent number of investors. They're going to need reporting. They're going to need a portal where they can look at their investments and track their tax documents, all the behind the scenes work that makes a big difference.
Certainly. And even with syndicators, I mean, there's features of our system, of our program, that cater to you guys as well. I mean, it started out as sort of, you would think, sort of separate, right? You've got different needs than we do, but we all have capital raising needs, right? I think our program probably fits that niche more than anything else, and other features that do dovetail.
That's fantastic. How are you increasing deal flow these days, Jay? I know that finding notes is a little different than finding whether it's single family residences, fix and flips, or even multifamily, but some of the things cross those boundaries. What are you doing to increase deal flow today?
Fortunately, knock on wood, being very opportunistic, which actually started in the pandemic, because the evolution was about from 2013 to 2017, I was buying almost exclusively notes. By 2017, note pricing started getting a little too high. Too many inexperienced investors were in the marketplace overpaying for stuff. So we started buying property. We started buying property off auction.com, things like that, right? And then we were buying, rental properties in Cleveland off the MLS in 2019, right? And then the pandemic hits, and now we've got, the market going crazy. So we actually ended up, fortunately, going back to one of our note sellers that I'd done business with over the course of years, and we started finding a niche of buying reverse mortgages in late stage foreclosure. So now we're picking up these mortgages. They're going to sale relatively quick, and we're getting them at really attractive discounts. And so we've stayed with that. We've been buying, we buy from a variety of specific sources, kind of on a forward flow. We're getting stuff, monthly, and taking stuff down on a continual basis. And that's spawned into, we still diversify and buy property. I mean, I in building my team in Pittsburgh, I call randomly. There's a strategic purpose to how I call find a team member, a realtor in a particular market. But as I found her on a note that I owned that was buying in Pittsburgh, she became the perfect realtor. The property that I found her on was actually one of her rentals. So she's a property manager and a realtor and a wholesaler and a project manager and an investor. So we've done we're buying the 14 unit through her this week. We're doing we just finished, resold a fix and flip. We've got 2 more on the market, going on the market this week. We've done 9 deals with her since January, just from the simple note that I did.
You mentioned you have a process when you're going into a market to find a new realtor. What does that look like? How do you narrow down to find that person who, you just described this realtor in Pittsburgh. She sounds like the perfect Leatherman that can put on an investor hat or put on a wholesaler hat or a realtor hat. You need somebody like that who doesn't just think through a traditional real estate agent lens. How do you go about finding that person?
The finding is the easy part. I mean, you're actually, instead of going on Zillow and just calling a realtor who's paid to be there, you actually find, from other comps, et cetera, those who have bought and sold in the area near your house, right? Because they know they know the market, right? But that's only one piece of it, and that's the house down the street. But if he or she's only a retail type, realtor, that's not my fit. Right? You got to want to work with investors. You got to like to work with investors. You have to have that knowledge and experience. A retail realtor doesn't work. Not for us.
Yeah. The landscape over the last 2 years has changed, and it's always shifting in real estate. We shouldn't be surprised when the market takes a twist and a turn, but I don't think anybody had pandemic at the top of their list for 2020. Moving forward, next 12, 24 months, what do you see that excites you and worries you about the real estate market, Jay?
Good question. Actually, I've always looked at life or business, I guess, is what's recession proof, right? You're going to have your challenges in certain industries, et cetera, that are going to be market driven. And I kind of feel, I've always maintained that what we do is somewhat recession proof by analogy as well. And I'll tell you why. Number one, I'm buying assets, mortgage notes primarily, at extreme discounts now. If the market turns, the discounts I'm getting on my notes will only get greater. Number one. Number two is the market stays hot. Fortunately, I'm buying stuff at attractive discounts, but my resale on the other end still stays strong. So I'm okay with that, right? And then the opportunity and the diversification and the various exit strategies that we have with notes, et cetera, kind of will allow us to always be able to pivot in any type of market change. I mean, right now, we've done our share of seller financing, and you say, well, seller financing is really prevalent when there's a downturn in the market. We've done really well in the strong market. Why? Think about it, right? The average credit score of people is still in 720s, but that doesn't mean everybody's financeable, right? So we've done really well in seller financing, even in strong markets. Some of that stuff. And then obviously, short sales will come back, and if short sales, I've done one short sale in my career on a note, which was hilarious. The realtor, everybody wanted it was in Chicago, which I have love-hate relationship with Illinois. I do really well financially there, but it's just all the crap I go through to get there. This was a short sale where everybody wanted a piece of the action. I had an attorney representing the borrower. The borrower had already moved. She wanted her fees for her client. She wanted her fees. The realtor wanted their commissions. It was just a joke with regards to, everybody wanted a piece of the pie. And finally, I just said no. I was ready to go to foreclosure sale 2 months later. And so they just went and picked the buyer's pocket and kept increasing the price on the buyer. So I would end up netting out what I was okay with. That's
Hey, being creative and finding solutions, that's a good path. And how people are successful. Ultimately, it's finding that problem and figuring out a unique way to solve it. Jay, as we're getting close to wrapping up here, would you have a habit or two that have contributed to your success that you'd share with the audience?
Being resourceful is one of them. I mean, for me, an old mentor told me one time, shoot, ready, aim. Right. So I'll dive in and figure it out later, versus those who get paralyzed and say, I don't know what I'm doing until I'm ready to be ready. I don't know, and I think you miss out. I think also you need to partner up with someone as you have that trepidation, which is very real and very common. You just want to partner up with somebody who knows what they're doing. Let them hold your hand and lead you through it. Because I learned by repetition. So, if I learned, and I got started the same way, partner up with somebody who knew what they were doing, and learn by doing, learn by taking the action. I mean, that's the strongest thing to do. I mean, I'm not I did well in school, obviously, but I'm not a book learning, book smart kind of person.
Yeah. Excellent. Well, thanks for joining us today, Jay. Really appreciate you sharing wisdom with the audience, and we'll look forward to catching up down the road.
Sounds great. Thank you so much for having me.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.